As we look ahead to 2026, the markets are positioning for growth despite a slowing economy. Now, job creation is slowing and unemployment is rising, putting the Fed in the spotlight. Now, recent data shows employment declines across many regions, with workers themselves feeling pessimistic about the job market. And Fed Chair Jay Powell acknowledging the slowdown, and market forecasts do point to a 25 basis point rate cut next year in March, with further reductions possible in June. With midterm elections less than a year away, political pressure is likely to increase and making monetary easing even more probable. Well, joining me this morning is Jay Hatfield, CEO of Infrastructure Capital Advisors. Jay, good morning. Thank you so much for joining me. So we just got those inflation figures, and we're looking at both cooler headline as well as core CPI for the latest month. But I do want to start out with market reaction. So this morning we are looking at the major stock averages looking higher, at least by 0.5% for the Dow and up by nearly 0.9% for the S&P. So with the S&P 500 up nearly 15% year to date, I know that you have issued your target for 2026. So tell us a little bit more about this.
Good morning, Remy. It's great to be on. Well, it's also a great time to be on because really the core of our bull thesis. So we have an 8,000 target next year, 7 this year, and our target this year is working pretty well. So by the way, you should sell when you get close to the target too. So when we got close to 7,000, we saw some selling. But the reason today is critical is the core of our bullish thesis is that PCE core would go below 2 next year. And part of that was really proven out today because we publish a real-time PCE index that's already at 2. And what was required to get the reported PCE down to our number was the roll down in shelter. And you saw shelter go to 0.1 for 2 months because they released 2 months in one time. And so that's getting close to what real-time inflation is, which is roughly 0 for shelter. And so if you project that forward, we'll easily get to 2%, and that'll allow the Fed to cut 3 times, and that'll support our pretty aggressive 23 times 27 earnings to get you to 8,000 next year.
And of course, the December Fed meeting just is in the rearview mirror. But of course, we're looking ahead to next year. So with expected Fed rate cuts as well as forecasts for the 10-year yield below current levels, how do you think investors should be positioning themselves when it comes to treasuries and also even high-yield bonds or preferred stocks?
Well, so we are bullish on treasuries that we think they'll tighten only 30 basis points, but we think the stock market's going to be strong, almost up 15% from here. So in that type of environment, if you were invested in fixed income, which everyone should have some, you should be out on the risk curve. So you should be in high yield bonds or preferreds. We have 2 funds, BNDS, PFFA, in those areas. Those are likely to outperform investment grade because when the stock market goes up, spreads tighten. So the spreads on investment grade are minimal, but they're relatively high on preferreds and high yield bonds. So that's the most attractive part of fixed income to be in if we're anywhere close to correct about the stock market being way higher and the bond market continuing to rally.
And of course, as we look ahead to next year, we know that there's a lot on the horizon when it comes to policy as well as politics, especially because 2026 is a midterm election year. But I do want to get your take on tariffs. I know that tariffs are expected to contribute a pretty penny to the federal deficit next year. So how significant is this for sustainable economic growth as well as confidence for investors?
Well, we do actually think it works out great for the budget deficit. And by the way, we're talking about modest tariffs that are like sales taxes. So 10 to 20% tariffs, not 100% tariffs. So not a trade war, just really sales taxes. And so we forecast the budget deficit with 400 billion of tariffs to go down to 1.45 trillion, which is only 4.5% of GDP. And that's an absolutely critical number because that's below the likely growth rate in GDP, which is 5. So if the deficit's below the growth rate, then you have declining debt to GDP. So we forecast over the next 10 years, we're roughly at 1 times we go to about 95%. So it makes the deficit sustainable. It's not great, but that does add to economic growth. We estimate 0.2% of extra growth coming from the tariffs and the fact that we're borrowing less and investing more.
And Jay, we can't have a conversation about the markets without talking about sectors and rotations. So with corporate tax rates as well as AI-driven earnings supporting equity valuations, what should investors watch for in terms of sector rotations and even potential market volatility next year?
Well, we think the market's going to be strong next year. You'll get your normal volatility after earnings or season ends, like you normally do. But we would be just like on the fixed income side, we would be out the risk curve. So we think reasonably valued tech stocks like Marvell and Amazon are good investments. Those are large holdings in our ICAP, large cap dividend fund. Apollo and KKR on the financial side, but also more boring regional banks like CFG, Citizens Financial Group, because the yield curve will then be upward sloping. So we think, financials are one of the riskiest sectors. Certainly tech will participate and industrials. So we'd be out the risk curve and not in the defensive utilities, consumer staples, those sectors. They'll do fine, but probably lag.
And Jay, finally, before I let you go, we have about 60 seconds here before the market opens. So I do want to ask you about potential risks that could derail the economic recovery next year.
Well, there's only one financial condition that matters, and that's the 30-year Treasury. It's down to 6.25. So unless we get bad data on inflation, we'll still get those Fed rate cuts and lower rates. But if we didn't cut rates, that would be a problem because housing could go into recession. So I'd watch the inflation data and the Fed, but today's report was pretty profound and validates our bull case.
Well, Jay, thank you so much for joining us this morning. I appreciate your time and wish you a happy holiday season.
Thanks, Remy. Great to be on.